Hi and welcome to The Full Perspective. I'm Charlie Thomas, the Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dissect the week's biggest stories. Today I'm joined by Insurance Insider's Managing Editor Catrin and James Thaler, who is leading our US News team. Welcome, guys.
Hey, how's it going?
So thank you for being with us. This week, we are going to start with Covid-19, and in particular, how the focus is now shifting away from property and its impact onto specialty markets. Given that, now is a good time to check in with the two big markets, that's Bermuda and London, to see where the ground lies. Turning to James first. James, can you give us your take on how Bermuda was positioned prior to Covid-19 and where it finds itself now?
Sure, absolutely. I mean, I think what's going on in Bermuda right now is really interesting because you certainly across the entire insurance sector, or both really, you've had a lot of change. The market has been in transition. The primary market has gotten a lot of attention in that regard. There's been a tightening of retro capacity. And the big question people have had for a while is, when is the reinsurance market going to turn? And for Bermuda, the reinsurance market is obviously of particular focus, and specialty lines of business as well. So coming into this year, you had a lot of rate acceleration, which has continued into 2020. Reinsurers were cautiously optimistic that rate improvement in reinsurance that was seen at 1/1 would continue. And I think now with COVID, reinsurers are much more optimistic than they were. And certainly you're seeing it at the Florida renewal. Rates are up pretty significantly. And I think the dynamic that COVID has introduced is people are trying to figure out what to do with their capacity. One of the popular quotes that people are bandying about is that suddenly capital is scarce and risk is abundant. So you have some people pulling back, some people deploying more capital. But I think the larger question that people are going to have to revisit is overall, what is their strategy? What value are they adding? Even coming into this year, there had been some sense that there could be some strategic pivots coming. We wrote in March that we actually thought this year, 2020, would be a bit of a prove-it year for some Bermuda companies, because you had obviously you had the last round of M&A that occurred probably finished up around 2 years ago, and there are some companies that deliberately chose to remain independent. And a certain amount of time has passed, and those strategies have played out, and with some degree of success, some haven't been as successful. And now you're kind of getting to the point where investors, stakeholders, trading partners are starting to evaluate, okay, how successful have those strategies been? So you have a couple of market leaders who have timed the cycle pretty well. They're growing extraordinarily. You saw among some companies 30% growth rates the last couple of quarters. And then you have some companies that are still dealing with some challenges, spent a lot of 2019 re-underwriting. So I think a lot of 2020 is going to be separating winners from losers. Scale is obviously a popular topic in Bermuda. It always is. But I think everything that's going on right now with COVID is magnifying some of that. Who has big, strong balance sheets to put to work? Who's able to leverage technology more efficiently? And then, if you think about the Aon Willis deal that was announced right at the beginning of March, that creates an additional urgency around scale and in terms of being able to leverage trading relationships. So I think, yes, COVID is introducing a lot of uncertainty. I think COVID is a big question on executives' minds, but you could argue that the big merger that was announced at the beginning of March probably made it even more imperative for companies to evaluate their positioning. And just, you saw that partner was kind of up for sale. Maybe it's not up for sale now. Who knows? Watford is now coming under activist pressure. Sirius is in the process of being sold. And obviously everybody knows what happened at Argo. So their fear is on the rise. Activism might become a more common occurrence in the Bermuda market now that there's been some level of success. So I think it's at a moment where, yes, society is sort of grappling with these big questions and existential questions, and I don't think Bermuda is necessarily immune to that. So I think it's right now we're at a moment in time where people are reevaluating, reassessing where they stand, and I think Bermuda, among all sectors in the insurance market, is certainly at the forefront of that.
Yeah, James, I'm actually interested because obviously the lots of the Bermuda reinsurers started off as property cat specialists, right, to capitalise on that opportunity. Since then, they have diversified their portfolios and there has been sort of an evolution. Do you think this leaves them in sort of a weaker or a stronger position with regards to the pandemic?
I mean, that's a good question. I mean, partly to your question, I think it's, obviously there are a lot of concerns around social inflation coming into this period. And, there are a lot of people thinking that this could magnify social inflation. So there's still the existing social inflation that still had maybe not fully materialized to the extent that people have been expecting. And so that the social inflation on its own was likely to sort of come more to the fore. But then, much like you see after a big hurricane or a big cat event, that there's additional social inflation. But this, to your question about diversifying casualty business, casualty is really where companies have grown significantly and been part of the pivot away from property cat business. And what you're hearing in the market right now is a discrepancy between companies thinking that they're getting right above trend. Some companies are more confident than others. But I think this gets back to, you'll start to see differentiation among management teams. Some companies have been better at managing the cycle than others. Some companies are starting to see rate improvement and diving in whole hog, where you might see some of the more shrewder underwriters who are starting to be more disciplined. So, there's obviously a lot of talk about kind of a historic soft market coming into this phase. And I think there are some people who are still being patient and waiting for what is called a transitioning market to actually become a traditional hard market before really diving in. And so I think that's going to be critical to evaluating company success in the developing market.
Okay, that's great. Thank you so much for that, James. Let's move on to our second focus today, which is to turn to London and ask how EC3 is positioned with regard to the current COVID-19 situation. Catrin, what's your take on that?
Sure. I mean, as James referenced there, that there is this kind of running groundswell of improvement in specialty lines, particularly around rate. And, traditionally London is very well placed to take part of that as the leading hub to write that business. Now, this was already starting to happen before COVID-19. There's a question around how much COVID-19 will now accelerate that trend. There are a lot of executives talking about rate momentum continuing into 2021. And we put out a piece on Friday around the London property DNF market, and there's a lot of optimism in that space. Lots of rate hardening, the pace of rate hardening accelerating. And actually, they feel that this is almost the majority of that momentum has come from that remedial action from the retrenchment of the US domestic market, which London has directly benefited from. And actually, once people start to get their arms around what COVID-19 losses really do look like on their P&L, that is what then will trigger a further kick on in rate momentum. So the interesting thing with this is, there's really still a question of whether London will be able to capitalise on this opportunity, especially in Lloyd's. And really, there are two elements to this. So, the first element is actually the size of the COVID-19 loss. Now, Lloyd's has put out a $107 billion industry loss estimate, and of this total amount, which is underwriting losses only, Lloyd's would take up to $4.5 billion. So Lloyd's did a lot of data work around this estimate, asked all its managing agents to do a market return in order to get to this number. So they're pretty confident. But obviously, there's a lot of skepticism in the market around whether that will be the final number, because obviously the situation is changing every day. And they're also worried that there's huge scope for Lloyd's to take a bigger share of that whole industry loss. So how the market responds to that pain, and whether that will actually impinge the ability of the market to capitalise on the opportunity is the first kind of big question mark. The second big question mark is that obviously Lloyd's in particular has come off the back of 2 years of remedial action that was pushed through by the corporation, everyone talking about the performance drive. Now, the headline kind of messaging on that was sort of devised by John Hancock and his team was, we prioritise bottom line profitability over top line growth. And as a result, lots of businesses dropped premium. They were forced to sort of put the brakes on growth, and that obviously created some disquiet in the market, but it has been starting to sort of bear fruit on an underlying basis. There is some improvement happening, but there's a question now, as London and the rest of the market comes into this rating opportunity, how much will Lloyd's syndicates be permitted to grow by the corporation? So to date, there has been some growth permitted, but it's been in line with risk adjusted rate and not a lot of exposure growth. And when you have the exposure growth, that's when you really start to progress as a business. So there's a lot of eagerness from companies to grow their exposure, but we're still not clear how much Lloyd's will permit that. And when I've spoken to Lloyd's CEO, John Neal, he's made a lot of positive noise around being flexible, around forgiveness. If you've got it in the plan and it makes sense, they'll approve it. And obviously, he is currently interim performance management director while they find a replacement for John Hancock. There is one thing as well that is interesting about this, is that the opportunity to grow will not be felt uniformly across the market. So Lloyd's has kind of pushed ahead with a regime of differentiated oversight. So the best performing syndicates historically have more freedom to grow and will have more freedom to capitalise on that opportunity. And this is best personified in the light touch syndicate cohort. So that includes MAP Underwriting, Munich Re Syndicate, Atrium, Beazley, etc. They actually have complete freedom. They get automatic business plan approvals. They have complete freedom to grow. And obviously, the less favourable your track record has been, the more the restriction will be on you for growth. So there will be this asymmetric impact on the market, really, on how much each is allowed to grow. And obviously, of course, the company market does not have a regulator in Lloyd's that can put the shackles on the growth.
I was just going to say, with all these questions around rate adequacy, it actually might not be the end of the world to have your growth ambitions limited. So it's depending on how the market shakes out, it actually could be to Lloyd's benefit.
Yeah, that's true. And it's still worth bearing in mind that Lloyd's, prior to this, it still racked up 3 consecutive years of underwriting losses. 2019 was still a combined ratio of 104%. So now 2020, there's zero chance of making an underwriting profit this year due to the pandemic, but it's worth remembering that this is a good opportunity for Lloyd's to kick on that performance drive exercise with the help of the improving rating environment.
I suppose one of the things I'd be keen to explore with both of you actually is, one of the key differentiators between Bermuda and London is Bermuda has the reputation for being able to adapt incredibly quickly to changing scenarios and has a better track record, if you like, of pushing forward with innovation and technology in particular. And Lloyd's has a bit of a checkered past, shall we say, in terms of its tech platforms and its pushes forward. What's both of your takes on whether Bermuda or London's likely to win the tech and innovation battle here that likely to come out post-COVID-19? Perhaps, Catrin, if we start with you on that one.
Sure. I mean, there's tech and there's also capital formation as well, isn't there? So if you can go in the capital formation part first, there'll be lots of people that would argue that London missed 2 opportunities for capital formation after 9/11 and Katrina, didn't quite see the same extent as we saw in Bermuda, for example. And there's a big question around in this current opportunity around how Lloyd's and London makes itself attractive to new capital. Because as we know, there are big challenges around cost and efficiency, which have not yet been addressed. That kind of leads me on to the technology point, in that in the past, London hasn't really embraced technology in the way that it should have. And there are big strides to do this. You've got the whole Future at Lloyd's regime. The LMG was kind of pushing this through with the London market and target operating model as well. But to be honest, this whole pandemic has shown that London and Lloyd's can change. And if anything, the kind of push to remote working and trading electronically, it's really kind of made that gear change for the market. And I would say that it kind of really vindicates the Future at Lloyd's strategy. So I feel positive going forward, but obviously I think, as we've mentioned in previous podcasts, that the whole pandemic has kind of put the brakes on Lloyd's pushing through some of its Future at Lloyd's strategy. So the jury's still out, I think.
James, what's your take on Bermuda and how it can fare in this fight with London on being able to be the most adaptable and attract the most capital?
I was just going to say, I think the operative word there was probably capital. I think that's where Bermuda has been the most adaptive. I definitely don't want to overstate Bermuda's technological capabilities. I think, like much of the insurance industry, there leaves a lot to be desired. But certainly from a capital standpoint, that's where you've seen a lot of evolution. That's where capital is coming in after big events. Right now, it is a popular talking point that could there be some new companies started similar as you'd seen after previous events. And from my personal point of view, I think it's probably pretty unlikely. I know that there are a lot of people that are looking at it. There seems to be a sentiment that capital raises might be a more common occurrence. But I think there's something about not having a lot of legacy challenges that's pretty appealing. And there's also a lot of strong management teams or certain executives that are available, and so they could make it work. And it's already been proven in the last year with Convex. So it definitely remains a possibility. I think consolidation is probably more likely. I think you already have a lot of existing capacity in the market. that would be well served by finding a bigger balance sheet. So I think there's still going to be a lot of change afoot. I'm a little bit pessimistic on how quickly the island can adapt from an efficiency standpoint, a technology standpoint. But I think if change is more likely to occur, it'll probably be more likely to happen in Bermuda than probably anywhere else.
Okay, that's great. Thank you. I mean, so much of this will depend on the macroeconomic situation too, right? In terms of whether we do find ourselves in a global deep recession, how that will impact on private capital markets, how that will impact the debt markets and everything else. So, and we're still some weeks away from understanding even a high level view of where that macro position will leave us in terms of capital generation. But, something to revisit another week. I'm afraid that is all we've got time for today. Thank you so much to Catrin and James for joining me, and thank you for watching at home. Until next time, stay home, keep safe, and we hope you'll join us again soon for another episode of The Full Perspective. Thank you.